Do I remember anyone's name? No. The only person you really have to be careful for is Tony. He'll send you to Italy and do so. Look at him. Make sure he doesn't leave early, okay? So, 11 o'clock, Tony. No. I love you. That's my friend. All right, well, we're gonna get started. Thank you guys for coming. Thank you for your time. I'm extremely grateful. I think we've been doing this now for a year. This is like a year that we've been doing this, which is really cool. And I remember our first seminar, Stephanie's mom came and supported her, and she learned some stuff that she actually went back to Social Security, and there was like a spousal. She knows Social Security stuff. I'm like, don't ask me questions. I'm like learning. I'm getting to her level. But her mom went back to Social Security and got like an extra $300 or $400 a month from a spousal benefit. So anyway, it's going to be a lot of fun today. So Stephanie is a Social Security 567 expert. She is the bomb. My name is Junior. And now if you go to the Starbucks on exit 19, my name is Julian, because that's what they wrote on my thing today. So if you go there, I got a different name. But it's great. Good morning. So I've actually worked with, you changed up on me. You're like back there now. So I've worked with Stephanie for 8 years. And I don't know how many of you guys have worked with someone for a long time, but it doesn't take you very long to get close to someone where you really know who they are and you're like, I'm okay. I love her. She's got a beautiful family. Her husband is absolutely amazing. She's got 3 great kids. But even before we were working together with clients, I watched how she treated her clients, and she has got the biggest heart. She serves, and she's honestly studied this subject for years now, and she loves people. Like I'm telling you, I'm just like, I love being in the point in business and in life where I can choose who I need to work with and who I don't, and I just love working with her. And I do want to say thank you to Spencer. He's running all the technology in the background, so thank you, Spencer. So we have friends and people that are going to be on Zoom later just watching this live. So if you see the camera, don't pick your nose. That helps, you know? No, I'm kidding. But yeah, no, it's going to be great. So today there's going to be a lot of information that Stephanie delivers, and it's very, very, I don't want to say fast, but there's a lot of information. Some of it, Kara, will be very specific to you. Some of it may not, because there's broad ranges of, net words, broad ranges of needs and ages and all that kind of stuff. So I promise there probably will be something that you can take, So I have a question. How many people here love asking questions? Okay. You are not allowed to ask any questions. No, I'm kidding. So I know you're going to have questions because it's a lot of information. We love questions. We do. However, we have 1 hour to deliver everything. So if you can, there's an evaluation sheet that right there. You can flip that and write your questions down. More than likely, we probably won't answer a lot of questions, if any, during the presentation. Unless you don't understand something, we can repeat it. But I promise, like every time we've allowed questions, it's like, then we're rushing at the end, and it's like, So we will meet one-on-one. We'll answer questions after the fact if you have questions. We want to get them all. There's just no way to do this justice and honor your time at the same time. So if you have questions, write them down. I think that's it. I just want to say thank you to Miss Rachel, and she is the bomb, Courtney from our office, and Josh is going to be working with our office too. So they came to help us and lend hands. Everything matters, the folders, all that stuff. So just thank you guys. There's no way we could have done it without you. So with that being said, can we please put our hands together and welcome Miss Stephanie Smith.
Thank you, Junior. What a great introduction.
You got this.
Appreciate you. Hi, guys. Good morning. I can see my screen with these. Okay. So, hi, guys. Thank you all for joining us. So happy you could be here today. And Junior, thank you for that amazing introduction. Junior is one of the best people you could ever wish to work with. He serves relentlessly at his church, and he is an amazing single father. And he's the first one in the office and the last one out, always making sure people are taken care of. So it has been a joy working with him. As he said, my name is Stephanie Smith. I am your Social Security 567 expert. Thank you all so much for coming today. I know that each and every one of you took time not only to drive here and register, but you're taking the time now to sit here and listen. So we want to make sure that these 60 minutes are some of the most impactful minutes that we could give you while you're here. So as I go over the basics of Social Security, as Junior said, can you please, yes, write your questions down. We do hand those evaluation sheets back into 567. The information also helps them evaluate what we need to add, change, so your feedback really does matter. Yes, this is a Social Security 567 workshop, but we are also going to cover how Medicare affects it, your investments, everything, long-term care, everything plays a part and they work synergistically, even if we don't know they do. Today we'll uncover how they do. So all of you have had questions, something's kept you up at night and brought you here. We want to help you with that. This is part 1. So part 2 is your guys' individual strategy session. That's where we will go over the questions that you had and we will run your reports and we will evaluate it and help you come to the conclusion so you can find out what your optimal claiming strategy is and how you can best go into retirement. Even if you're already claiming Social Security, this is still going to be good information for you. Okay. Who knows what this mountain is? Where is? Mount Everest. Yes, I knew you would know. All right. So this is Mount Everest, but this is just a representation of your financial landscape. The left side is the accumulation phase. This is when you're accumulating money, you're working. We call it going up the mountain. You're putting kids through school. You're trying to pay down your mortgage, and you're trying to get all those things done. And then the next phase is the distribution phase. That's the back side of the mountain. This is where you're going into retirement. It's a completely different phase. You've accumulated all your income, and now you're figuring out how to take it and the best way to go into retirement. So who we are not Social Security Administration. And I am very thankful for that. Again, my name is Stephanie Smith, but I was born Stephanie Kimball in New Jersey, in the middle of nowhere. A very small farm town by the Delaware Water Gap. I have a degree in teaching from Chaminade University in Honolulu, Hawaii. And I have over 15 years experience in the healthcare and education and financial services. Currently, I live in Pinellas County with my amazing family, my husband Zeke, my 17-year-old Angelo, who is now driving, and God pray for us. He wants to be a Formula One race car driver. And I'm so proud of him, though, because he started his own detailing business. So he's already for a year been doing mobile detailing, and he's getting into boats now. So we are very proud of him. And then Mikey, he's 8 now, and he is just the biggest ball of love and energy. He's on the autism spectrum, but the smartest little boy you'll ever meet, definitely gonna be an engineer. And then Lola is 2, watch out. She is defined terrible twos, and she is a tornado, but she's so sweet while doing it, which you guys know makes it very hard to discipline. But why do I talk about my family? Because my family and your family is why we are here. Who here has ever been responsible for taking care of a sick family member? Lots of hands. Well, you are not alone. My grandmother, I have 2. I had the honor of taking care of my grandma the last 7 years she lived with me. She had dementia and Alzheimer's. And in my past life, I was a nursing assistant, which gave me the skills that I needed to take care of her. So she moved down to Florida with me. And she passed away about 5 years ago in February. But when you step into that role, you don't really fully understand what it means. You don't know that you can't go to work some days because she's going to burn the house down because she was cooking eggs and forgot, or that she might elope and not come home. You know, you don't know all those things going into it. And I was never gonna let my grandma go live in a state-run facility because that's where she would have gone. Why? Because she didn't plan well. She didn't have the tools, the resources, she didn't know any of this stuff. So she would have gone into a state-run facility. And, you know, I just like, all she had was a $5,000 life insurance policy, and really it wasn't even enough for what my parents wanted to do. So this topic is very close to home for me, and I love sharing it with you guys. Junior, who I'm sure most of you, my partner who you met, I don't know why that's there. I'm sorry. Please forgive me. My notes have changed. Oh no, I did want to talk about Junior. I'm right, look at that. I was like, Junior, who you guys already met, he leads by example. I've already told you how amazing he is. His servant leadership is above average, and he approaches every situation with intensity and love and care. So one of the biggest reasons I love working with him. Our other specialists are Robert Belcour. He is the managing partner, and he was on the financial chair for the Literacy Board in New Jersey, Norfolk, New Jersey. For 18 years he served for there. And now he owns a couple multi-million-dollar companies, and he's been in the industry for over 30 years now. And then we also have Diane Goldman and Cheryl Crawford. Both of them have over 30 years of experience as CPAs. They both have MBAs and have been heads of accounting in multiple companies. So needless to say, we have a lot of very smart people helping us. They have also been an integral part in the Social Security software that we're able to run all these magical reports for you guys. So it's really great. Yes, we love them. So like I said, we'll provide you some complimentary reports. That's what we do in part 2. We can run your reports and we integrate them with your Social Security number to give you the best plan possible going into retirement. Okay, so let's see. Let's learn a little bit. All right. In this segment, you'll understand how to qualify for Social Security. So you need 40 credits in order to qualify for Social Security. You need 1 credit per quarter, and to get a credit in that quarter, you had to have earned at least $1,890. So that gives you the ability to get 4 credits per year. That's why they say it takes 10 years in order to qualify for Social Security. And so, but they do go off of your 35 highest earning years. Full retirement age is the age at which you as an individual can collect your 100% of your benefit amount. Now, when Social Security was first signed into law in 1935, everybody's retirement age was actually 65, so it was much easier. But now, based on changes made in 1983, the full retirement age is based on your year of birth, and you can look and find your year of birth on the left and see what your full retirement age is. Anybody can begin collecting their benefit at age 62, but it's true for all retirement benefits with Social Security. If you collect it early, it will be a reduced amount. So you can get it at 62, but it will be reduced. And on the other hand, you can defer all the way up to age 70. And if you do, it's 128% of what your benefit actually is if you go from full retirement age to 70. So now that we know how, let's see how it can help you and the different claiming strategies. Because it's one thing to know how Social Security works, but it's another thing to really fully understand how it relates to you in your personal situation, because everybody's situation is so different. And that's where we come in. We help you guys define your optimal claiming strategy, and that's what we're here for. So first benefit we'll cover today is the spousal benefit. If you're married, you're able to receive the greater of your benefit or your spouse's benefit. And it's going to be based on either your record or their record. So the spousal benefit says you can receive up to 50% of your spouse's full retirement age benefit amount. It's not calculated off of another age, it's calculated off of your spouse's full retirement age. You can collect the spousal benefit only if your spouse is already collecting their benefit. You do not have to be married for any specific amount of time. And you can start the benefit as early as age 62, but like I said, it will be reduced. So let's look at an example of a claiming strategy. We're going to use Mark and Tina. They are married and they are both 66, and both of their full retirement age is 66. So Mark's full retirement benefit amount is $2,400, and Tina's full retirement benefit amount is $1,000. Combined, that would give them $3,400. So let's see how they can leverage the spousal benefit to maximize their household income. The first thing that we recommended is Mark defer his benefit. If Mark defers his benefit to 70, he'll get $3,136. Tina will start collecting hers and get the $1,000. So she starts getting hers, and then Mark continues working, and he retired at some point, but he did not collect his until age 70. So going into retirement, that's a very powerful number, because Tina would have never been able to get that much. Therefore, if Mark dies, now Tina will adopt that $3,136. And what it did is, instead of them having $3,400 total, now they have a total of $4,336 together in retirement. Now I want to pause real quick. I didn't say this, but I should have said this. So Mark defers his. When he starts collecting his benefit, Tina has to call Social Security. Tina has to call and say, hi, my husband is now collecting Social Security. I believe that I'm entitled to a spousal benefit. Social Security is not going to do that for you guys. They're not going to call you up and say, hi, Tina, your husband started collecting his Social Security benefit, and we just realized now you're entitled to more money. They don't do that. This is why we do these presentations, so that you guys know you're entitled to more. My parents are a prime example. They were on Social Security for, 5 years before I started doing this, and didn't know that my mom should have been getting more money. So it is very important. The next slide is about the divorced spouse benefit. It's very similar to the spousal benefit. If you're divorced, you're entitled to receive the greater of your benefit or the greater of your ex-spouse's work record of their full retirement age. However, the eligibility requirements are slightly different. You have to be single. You have to have been married to the person for at least 10 years and then get divorced, and be divorced for 2 years and be single, not remarried. And if you do that, then you can claim the divorced spouse benefit. And it will increase yours to up to 50% of the ex-spouse. And again, you can start as early as age 62, but it's true with all benefits with Social Security. If you do, it will be reduced. This slide is for people who are, this went with it. No, it didn't. I skipped. It's Stephanie. Okay, this is the survivor benefit. If your spouse is deceased, you're entitled to receive the greater of your benefit or 100% of your deceased spouse's benefit, which is different because in the divorced spouse benefit, you only get up to 50% of their full retirement benefit amount. But the widow or the survivor benefit, you can collect up to 100% of your deceased spouse's benefit. You can start this one as early as age 60. It's the only one you can start at age 60. However, again, if you start collecting it before your full retirement age, it will be a reduced amount. This slide is for people who are single. And never have been married. The key to maximizing your benefit is typically deferral. Again, it's always going to depend on your other resources and timing of your retirement, but typically, if you're single, deferring is a good option. Okay, this is the retirement earnings test. This is fun. When you claim Social Security benefits before reaching full retirement age and you continue to work, Frank, I know this is something you had questions about, you are subject to what's known as the retirement earnings test. And what this means is Social Security will look at what you've earned and withhold some of your benefits to a certain extent. So during the years before full retirement age, Social Security will hold back $1 for every $2 that's earned in excess of $24,480. And then, once you reach full retirement age, so this is very, very muddled, but in the year you reach full retirement age, they'll hold back $1 for every $3 that you earn, in excess of $65,160. But then, starting January 1 of the calendar year you reach full retirement age, they'll hold back $1 for every $3 up to $65,106. Once you actually hit your birthday month of the year you're in full, you start earning your Social Security at a higher level. So everybody's misconception is that you're taxed or it's lost and it's just gone to you, but it's not. In the year of full retirement age, they do a recalculation in your birthday month, and then you will start receiving your benefit at a higher level. So you can continue to work and not worry that they're going to keep your money, because that's not what happens. Okay. Guys, Americans leave up to $25 billion in unclaimed Social Security money every year just by choosing wrong elections. So please don't be any of that $25 billion. We do these complimentary reports for you. You know, we run these strategy sessions for you, complimentary. Use us. We will help you figure out what's your best claiming strategy. Okay. Let's turn our discussion to Medicare for a few minutes. Medicare and Social Security used to go hand in hand at age 65, but now, as we discussed earlier, you'll still get Medicare at 65, but your full retirement age, claiming age, is now different dependent upon your birth year. So there are some important things to note. Medicare is not automatic. In most cases, you must proactively apply for the Part B, the medical, and Part D, the prescription. If you are eligible to age 65, your enrollment period starts 3 months before your birthday, the month of your birthday, and 3 months after. That's a total of 7 months to apply. And then, if you don't apply on time, there is a penalty. So keep that in mind. Your premium will increase 10% for every 12-month period you were eligible but did not apply. And it is not a one-time penalty, it is a forever penalty. So applying at the right time is important. And they're not free. Medicare Part B and D are not free, but there is the cost, but you can purchase a supplement or an Advantage plan in order to help mitigate that. Yes. Let's start not with Irma. We go to Irma. All right, let's start with Irma. The premium, the base premium for Part D depends on the prescription plan you choose. The premium for Part B this year is $202.90. We can call it $203. On average, your Part D plan will run anywhere from $0 to $40, just depending on what you choose. But the total cost is determined by your income in retirement, and the thing that makes it true is IRMAA. IRMAA is your income-related monthly adjustment amount. And what that means is it's basically just a pesky fee that the government adds to your premiums as a result of earning too much money. And yes, we want to be here. All right. The calculated surcharge, so they calculate your income based on your most recently filed tax return. And then the calculated surcharge is added to your Medicare monthly base premium to determine your total premium for that year. IRMAA was created under the Medicare Modernization Act, and it was first implemented in 2007 and later for Part B and later expanded in 2011 for Part D. The purpose was to offset the ever-rising cost of healthcare. So we don't expect it to go away anytime soon, because who thinks healthcare is going down? Yeah. So we don't anticipate these charges going away at all. Your actual IRMAA surcharge, like I was saying, is based on your income and filing status. So each year, Social Security Administration calculates your modified adjusted gross income, MAGI as we call it, and then it is based on your most recently filed tax return, which was from the year before. And essentially, MAGI is line 8B of your tax return plus tax-exempt interest. So all of your income is included. It is interest, dividends, earnings and IRAs, 401ks, 403B distributions, pensions, and capital gains. Once calculated, they take it to the chart, this chart, and if your income exceeds, if you're married filing joint and you're at $218,001, you now will experience what's called the cliff effect. So if you're just $1 over in these brackets, you will see the IRMAA penalty. And so if we quickly look at the chart, and if you file a joint tax return and you're in, I already told you that. If you fall into the $218,001, you'll be in the next bracket. What that does, though, is it adds $888 for your Part B and $164 for your Part D per year of addition. So it's $1,052 extra a year for your Medicare premiums. And that's just as a result of earning $1 too much. So you can see how big $1 can make a difference. And if you were just $1 less, you'd have no adjustment. So, and if you're a couple, it's doubles. So think about that. You take that 1,052 and multiply it by 2 if you're a couple. So what that would do is makes it so every year your annual cost would be the $2,436 plus $552 per person if you take all those and add it up. So we can help with that. This may or may not be obvious, but timing is important. So I kind of already told you guys this, but it still doesn't sink in sometimes. It's when they file your most recently filed tax return, they're going off of it from 2 years prior. So now in 2026, they're going to calculate your Medicare premiums based on what you earned in 2024. And I know it doesn't really make sense, but that's how it works. But this makes managing Medicare more important. So if you have fluctuating income in retirement, for example, Roth conversions, 401k investments, withdrawals, what can you do? First of all, plan, work with your CPA. They will know different strategies that you can do to not experience the cliff effect. Also, some of the reports that we can give you and some of the information we can help with will also help you guys through that. Many of you will stop working in the year before you want to apply for Medicare. This is considered a life-changing event, just as getting married, widowed, losing an income-producing property. If any of these events are not reflected in your tax return from 2 years prior, we can appeal that to Social Security very easy with a form. It's a SSA-44 form, but that is something that we can help you guys with as well. All right, let's look at a case study. We're also going to look at the 5 risks in retirement. Okay, one of the things that's going to happen is you have to identify where your risk is. So there's 5 major risks that the baby boomer will have in retirement. Our job is to mitigate it. The first one is longevity risk. Stephanie, will I have enough money to last the rest of my life? People are living longer than ever now, so, which is a blessing, but it means we have to make your money last longer too. And the next one is a health risk. What happens if one spouse ends up needing long-term care? How does this impact the life of the other spouse? How does it affect them financially? Heart attack, strokes, cancers, stays in skilled nursing facilities. These are all things that affect our income and if we don't plan and properly address it. 3 is mortality risk. What happens when financially one spouse passes away? Social Security doesn't continue as 2 checks, it converts to 1. So you lose income there. Pensions often do the same, it just depends on how they were elected. 4 is inflation risk. Baby boomers have been around. There's over 14,000 baby boomers turning 65 every day for the next 14 years. So there is a lot of them experiencing rising costs, and you guys know about that. The question is, will your income keep up with inflation over time? So that's also where we will come in. And finally, 5 is market risk. This is where we have to understand the difference between averages versus actuals. For example, if you have $1 million and the market drops 30%, now you're down to $700,000. Next year it gains 30%, but you're at $910,000. The average says you broke even, but the difference, you're not back up to $1 million. So sometimes averages versus actuals they're like a misnomer. Ooh, and now we're going to go to the case study from Mike and Rose. Okay. This is an actual couple that has come through one of our seminars and have been one of our clients in our company. And so Mike is 63. He's a PE teacher. Rose is also 63. She's an educator at Lemon Bay High School. And they have a couple kids. They have two kids, 2 grandchildren. Rose currently wants to work and retire at 66, which also happens to be their full retirement age. Mike, unfortunately, prior had a bout with cancer about 3 years before. Both wish to stay in their house if they can. And they also wish to take 2 vacations a year and leave legacy money to their grandkids. That is my eat alarm. I am so sorry. Okay, so Mike's salary is $7,167. Rose's salary is $5,417. Their monthly expenses are $5,250, leaving them with $7,334 before taxes. Let's look. Mike has a 403B with $150,000, which simply put is just a 401k tax code for teachers and municipalities. He also has a traditional IRA of $100,000. Rose has a 401k. It's $800,000, but it looks like it's 2, so it's broken up into 2. And then, and in 2009, she took a 30% hit. So now that we're coming up to retirement, she was deathly scared of losing any more money. One of the first things we're going to do is look at an evaluation on their life insurance. Keep in mind, Mike had cancer 3 years prior, but he had a policy in place. It was a $500,000 term policy. and it expired 4 years from the time we were seeing them, and he was paying $91 a month. Rose had a $70,000 permanent whole life insurance policy with $40,000 cash value in there. She was paying $71 a month, but neither of them had critical illness or chronic care or anything like that. Does anybody know why? Because they were 40. They were going up the mountain. They didn't think that they were going to get sick or anything like that. So cancer plans, anything like that was not an important thing to them. Now, the most important thing to do in retirement is to get into a liquid position. This is not if something goes wrong, it's when something goes wrong. We have all had something happen where the fridge goes out or your car goes out. So this is just one thing we like to help you do. Now, I gotta get back to my notes because it kicked me out. Okay. Now let's see how we were able to help Mike and Rose, because this is really cool. The first thing we told Mike is that you're going to defer your Social Security. We wanted to build it up to $3,210. We instructed Rose to turn on her Social Security at her full retirement age of 66, which gave her $1,823, which is bigger than her spousal benefit would have been, which is why we instructed her to turn it on, because waiting wouldn't have given her a bigger spousal benefit. One of the things we did is we took Rose's $800,000 401k and we used what's called the ladder technique, and we broke it up into two $400,000 policies. The first one is going to distribute $1,792 every month for the rest of her life. The next one's going to distribute $2,218 a month every month for the rest of their lives, both of their lives. And the brokerage account, which was the 403B, we took a small 5% distribution, which gave $781. We converted the life insurance proceeds into income, and they were getting $1,000 from that. And that gave us, and then we didn't use the $100,000 traditional IRA for income. We needed that for long-term care, which I'll show you in a little bit how we did that. And that gave them 4 fixed streams of income, guaranteed fixed streams of income. Very predictable, taking their fixed income to $13,011 with both of them alive. If one of them dies, it will go to $12,188. The only part of that they'll lose is the life insurance income. So that means that as a single person or a widowed spouse now in retirement, their fixed guaranteed predictable income is $12,188. That is a powerful number to take into retirement. Minus their expenses, it leaves them still with $5,731 extra to do with. So having a good retirement plan and not having long-term care coverage or a plan for it is like having a castle without a moat. And what I mean is the castle is a representation of your liquid bucket and the income bucket. The long-term care and the life insurance is the moat around it to protect your castle. Okay. So I want to tell you guys a little bit about the long-term care coverage and kind of how we do that. So you may have heard about people talking about moving assets, like taking a home out of their name when they get into retirement, or moving money for a Medicaid spend down. The reason people do that is because they're concerned of the high cost of medical. And usually that doesn't happen until you're in it. Most people, I don't want to say most people, but a lot of times people don't start thinking about this until a health event occurs, or you get to a certain age and you realize, okay, I got to get this done. And then it's a race. So we're trying to help you guys avoid that. To give you some perspective, Ronald Reagan lived with Alzheimer's disease for about 10 years, and the cost of care that estimated over that 10 years was about $1 million. So it's an expensive. Excuse me. So how do we prevent against that? We use the asset-based long-term care product. That's kind of how we do it. And that is when you put a certain amount of money in. In this case, we put $100,000 into an insurance company. It's completely liquid from day one. You can take it back anytime you want without any penalties or fees. If you require long-term care, the amount will double to $200,000. And then it will pay about $4,000 a month for Mike and Rose for about 50 months. Most people, the typical age range time that you're in long-term care is about 4 to 7 years. So just depending on the person, that's typically about how long people require it. So the 50 months would cover if they're expected to stay that amount of time. Now, if they don't use that money, let's say they have a long-term care event and they don't use the money because they're already paying for it out of other sources, that money will go to their loved ones. Then becomes a death benefit that you can leave, and it's not reduced. It pays out at $200,000, so that's a big deal. There's really only 3 ways to do it. The first way is long-term care traditional, which most of you probably know, like John Hancock or Genworth, long-term care plans that you can pay into. The way those work is you pay into them, but if you don't use it, you lose it. Most of them don't typically have a cash benefit that will come back to your family. That's not how the traditional way was built. And then the other way is through life insurance or single premium asset-based long-term care. The last thing we're gonna do is show you the insurance review that we did for them, for Mike and Rose. So Rose had that $70,000 whole life policy with the $40,000 cash value in it. That was $71 a month. We were able to convert that into a universal whole life policy. We took her $40,000 cash and transferred it into the new one. It's called the 1035 exchange. And then her premium stayed at $71 a month, and her face value went from $70,000 to $495,000. And then Mike, remember, he had cancer, so it wasn't as easy to apply for one for him, but luckily enough, his policy that he already had a thing in it called a conversion rider, so that allowed us to transfer it into a universal whole life policy, which gave him a face value of $150,000. Yes. Yes. I was just about to say, yes, I eat a lot. No. Yes. The face value was reduced, but he was happy to have that fixed amount now that he knew he wasn't going to lose. And at the same time, it's now accruing interest. So it was a much better policy too. So let's look at the goals met. All right, the longevity solution, we actually were able to give them 5 vehicles that are gonna give them a guaranteed income and fight off market risk, with which market risk we basically eliminated. So health risk, we provided long-term care without adding any premium, excuse me, without adding any premium to their monthly bills, which is a big deal. And inflation, we pushed Social Security off as much as we could. That helped a little bit. And we used different retirement vehicles that will increase slightly over time with the cost of living. So that's amazing. And then we were able to use the life insurance in place to get them better policies without adding any additional payments. So the goals were they wanted to retire at 66. They needed at least $5,000 extra to live on. They wanted to stay in the house to be around grandkids, leave money to their grandkids for college, and vacation 2 times a year. We were able to meet all of their goals. And then, I know some of you probably have questions about this. We're not going to spend a lot of time here, but many times. So changes from the big beautiful bill that you guys may feel. There's no changes to Social Security claiming ages or core benefit eligibility rules. There's no changes to spousal, survivor, or divorced spouse benefit rules. Social Security benefits may still be taxable under current law. New temporary senior tax deduction available from 2025 through 2028. The deduction may be $6,000 per eligible person or $12,000 per qualifying married couple. The deductions phase out at higher income levels. 2026 Social Security work credit increased from $1,810 to $1,890. And separate Social Security administrative updates include stronger identity verification procedures, and Social Security overpayment recovery rules have become more aggressive. So they're going after more people who they think owe them back for different things. That's been a thing too. While there's a lot of headlines, the biggest takeaway that we can get from this is that the core Social Security benefit rules remain largely unchanged. Claiming strategies, survivor benefits, and spousal benefits are still intact. We're seeing bigger movement on the tax side, and there is now a temporary senior deduction available through 2028. So that could help you guys. And lastly, we're seeing some administrative changes that are doing tighter identity verification procedures. And yes. So how do you guys go about seeing what you need? In order to run your Social Security report, we will need your primary insurance amount or your PIA. This is your monthly benefit at your full retirement age. And you can get this right off your Social Security statement. If you guys don't know how to log on here, if you've never been on here, I am an expert at getting on this site, so I can help you get in here. And if you already have been logged in there, it's really easy to download the report. Guys, if you haven't been on, I suggest you go on the site. There's actually a lot of really cool tools on there. You can pretty much see everything you would want to know. They even have calculators now, so you can look at future income. So, guys, that was mostly it. I hope you had a great time. Thank you so much for your patience and being here. It was such an honor. I'm going to bring Junior back up so he could close us out. Thank you. Thank you.
Hey, we are on time, dude. This is like awesome. You guys did a great job. You could have paid me $1 million a year to deliver that. I'm like, I can't memorize all that. Even with notes, there's no way I'm doing that. So, no, this is great. How many people got something out of this? Did you get something? Okay, good. I guess Tony.